Hello and welcome to another edition of the dOrg Hot Seats. I've got Adley with me this time from
Hello.
Usual Protocol. Hi Adley, how's it going?
Fine, and you?
Very good. Very excited, actually. Very excited for today. I think it's going to be a very timely episode because, stablecoins are all the rage right now. And yes, they were all the rage at the beginning as well. It was like one of the first use cases of crypto. I remember Tether. I think it wasn't called Tether in 2014, and then DAI. And actually, DAI was one of the things that draw me into tokenomics, because I found it fascinating how it could be backed by ETH and then it was stable. It blew my mind at the point. And then it sort of like kind of fluffed off. It's always been used, especially in countries where their own currency is a bit weird. But now it's coming back with a vengeance. Why do you think stablecoins are back in the table?
I think there are several reasons. The first one is like it has been growing all the time. It's just that people weren't looking. And clearly there is a lot of country where it's useful to have permissionless currencies, I would say, and access to external currencies. And Tether gives that. Very conventional also for long distance, etc. I think the second reason is also simply the fact that crypto is growing. So as all pairs on exchange are linked to stablecoins, the more activities and the more market cap there is in crypto, the more stable you have on the other part. I would say that the last point, no, there is two others, but another is that it's become profitable to be a stablecoin because it was not profitable when Tether start. And I think they had also a lot of incentive to spread more than before because it was very profitable. And I would say that the last point is maybe the regulatory aspect, where it's become more and more evident that stablecoin will be part of the landscape, and even United States are quite open. Europe has made MiCA, etc., etc. So I think all that together make this ecosystem boom. And clearly, since the beginning, for me, there is like not a bland lie in the ecosystem, but in 2017, when there was like I would say the blockchain bullshit era, we were like everything but not payment and financial stuff. But the killer app of Bitcoin and all crypto since the beginning has always been mean of payment and store of value in certain way. So I think that it's natural that the first vertical that works is the payment one, and currently it's more convenient to pay with stable coins than with crypto. And I think that's why there's all that. And another very important point is the state of the DeFi. State of the DeFi was very at the beginning, like 5-6 years ago, and now we have a whole stack of services, etc., that have made their proof. And so you can directly integrate with a lot of services if you start using a stablecoin or issuing a stablecoin.
Absolutely. By now, it should be clear that Usual Protocol deals with stablecoins, but maybe you can tell us a little bit more about Usual Protocol.
Yeah. For Usual, the goal is simple. Since the beginning of the stablecoin era, I would say, as there was, like you say, Tether, and Circle came a little bit after. There was DAI in between, etc. But we can classify stablecoin in, I would say, 3 different manners. Stablecoins that are backed by the same currency instrument, like T-bills, money market fund, whatever, but denominated in the same currencies than the stablecoin. There is basket-backed stablecoin like DAI. It could be crypto, it could be other stuff. But anyway, it's over collateralized and it's backed with different assets that are not necessarily the same nature of assets than the currencies. And there is the full algo stable, like Terra, etc., basis, and no one has succeeded on that right now. And we all know how it was pretty brutal. And the point for us was like, okay, so you have tethers that make billions per quarter. There is a DAI that is interesting, but CDP model is not the most natural for user. It has proven that like the fiat-backed stablecoin are more efficient, the same as Tether and Circle, and clearly spread more. And our goal was to make an alternative to that two bank-like stablecoin for something that is more DeFi and crypto ethos with a share governance and open protocol. So that's why we have built usual. The goal was clearly to just get back the power, get back the ownership, because crypto allows that. And currently, we are just recreating banks with Tether and Circle. So they have made big services for the ecosystem for onboarding many new people and capitals. But clearly, we can do better in terms of architecture as we have better means with the crypto smart contract and crypto possibilities. So
Nice.
yeah, if I would say one stuff is like we wanted to create an alternative that is with the same efficiency and with the same structure in terms of collateral and backing, but with something decentralized in terms of governance and revenue.
Right. So very good point. Revenue.
And I would say last stuff is transparency because like, it's quite hard to have transparency of centralized entity sometimes where on our case, we only use RWA token. So everybody can check what is the collateral in real time in certain way. We have no asymmetrical information with the users.
Yeah. You mentioned revenue, and I think on your website as well, it mentions that redistributing the value generated through the users is a big part of why you started Usual. Now, where does that yield come from? Maybe explain for our listeners.
In our case, it's pretty simple. The main part of the yield come from the collateral. And the collateral is T-bill, so it's T-bill. I go simply, but it's there is some repo, some T-bill, so it's money market fund, but it's near to the Fed rate. And we have several other areas in the protocol where there can be some fees, etc. Like when there is a redemption, there is a small bips that are taken some to avoid attacks on the Oracle update of the collateral. So you have some area of the protocol where there is some fees, and we also have services like the USL, that is a fixed borrowing rate market with for USD 0++ holder. We also have some vault where it's possible for a user to deposit USD 0++ and allocate to another strategy that boosts yield. That there is a small performance fees for the DAO. So yeah, we have the main source is collateral, and after there is several services on top where the DAO earns some cash.
Nice. Okay. And how does that get redistributed to the users?
So it's a evolving process. At the beginning, we were like dispersing 100% of the revenue, but it has been not very impactful on the price of the token. So there was a lot of people that was even more exploiting that by taking a short and holding the token. So we have reduced that to 30% to have abilities to make buyback. And on this 30% that is distributed to holders, they have to lock. They can lock 1 month, 3 months, 6 months, 1 year, and depending the length, you have more or less yield. And currently, for 1 year, you have 46%, I think, of APY in real cash, because you clearly have the cash that is earned by the DAO.
Right. So the revenue is not in Usual token; it's in cash.
USD zero in our stablecoin.
Which is in your stablecoin.
Yeah,
exactly.
and clearly it was important for us because, like, when we saw all those protocols that have no revenue, we think it's crazy in certain way. We really think that crypto is mature enough to have profitable business and profitable protocols and profitable DAO. And what we want to do is what we wanted to do since the beginning is to have something that is profitable. And it's a little bit a double-edged word, I must admit, because when there is no revenue, speculation is at maximum possibilities. And we suffer a little bit from the fact that we have revenue, because when you have revenue, I don't know why, but in crypto, it's cap your possibility in the mind of people of growth. So it's an in between, but in terms of alignment and ethos for us, it was very, very important to have that a clear goals to have something that is profitable day one in certain way, and that shares that with users simply.
Good, thank you for that. We've mentioned USD zero, we've mentioned usual, and then there is also USD zero plus plus. Can you tell us exactly what's the difference between these three tokens?
Yeah, so usual is a governance token that you can stake and lock to earn the revenue, like I say. You have USD0 that is our vanilla stablecoin without yield, without anything, same as USDT or USDC, that is PEG, etc. And we have USD0++, that is a bond, that is a way of accessing to usual token reward. So the goal, and it's a bond that is locked on 4 years, that is liquid. You can resell it, but it's locked on 4 years. You cannot have the principal before 4 years. And it's one of the only way to acquire usual token in certain way. And why we have done that? Because in our mind, it was rewarding people that provide long-term revenue to the protocol. And all the tokenomics is designed to have a symmetrical emission with revenue. So there is no like a pre-given token.
Right. So as the zero plus plus is sort of like the
it's like the saving account in certain way of the protocol.
Okay, so for a bank, it's a savings. It would be the
it's
savings
like
account,
a
deposit,
term
and then
saving account. Yeah.
right, and then the banks then have enough capital to go and buy treasury. It's how you
Yeah,
acquire.
if we do like a metaphor, it's like if you are in your bank account, when you deposit to your bank, it's USD0, the one that is in your in checking account, and when you deposit on the saving account, it becomes USD0++, and instead of giving you the yield generated on the saving account, it gives you directly share of the bank, and the bank will pay you with the yield generated on the share you have.
Okay, perfect.
In certain way, if we do kind of metaphoric stuff.
That makes a lot of sense. Yeah. Thanks for that metaphor. I know that there's like lots of regulations, sort of money transmitting and what sort of assets are there. This is very, very regulated, and I know that redistributing revenue would be for a stablecoin would basically turn it into a completely different asset, and
that's also why there is clearly two separated assets, and that's also why we give share of the protocol, because it's not directly the yield generated. It's like some ownership we give and not the yield. So it's a little bit different, and it was also to align, and it's a good way to spread in certain ways the governance token among users and the most committed user, I would say, because they give cash for a long time, and it's amount based. So yeah.
Yeah. Excellent. Okay. We've talked a little bit about what it is, what different types of tokens. You manage a huge amount of money. I think it's like how much is the latest number?
Right now, I think we are close to 800 million.
800 million. And that's a lot of money, and for smart contracts that get hacked all the time. So let's talk a little bit about the mechanisms, the security mechanisms that you have in place.
So we have a lot. First, the collateral is permissioned. Like for example, if you were able to steal the collateral, that is in huge part USYC, you will have to be registered at USYC as a KYB entity. And if you exit, they will check which entity exit. So complicated, I would say, to steal the collateral. But even if there's that, we have a lot of value checking and collateral checking that are always in place with some circuit breaker and stuff like that. We have Exagate partnership that monitor all our smart contract always, etc., in many kind of events in the protocol. We also have the biggest bounty of all time, near 20 million with Sherlock. So if there is somebody that can prove that he can access to the collateral and put in danger the protocol. We have made lots of audits with different firms, Belsec, Cantina, Spearbit, etc. Lot of different firms. And yeah, after we also have some external security teams that can snipe as white hat if there is something, and like all the other stuff doesn't work in terms of a circuit breaker. Yeah, that mainly it. Like we put the max we can on audits. We have the biggest bounty of the ecosystem, and we have a lot of monitoring tools and security measures. And right now, we never been hacked in terms of stealing funds.
In terms of stealing funds, huh? So in what terms have you been hacked?
We didn't have been hacked. It's like we had one exploit on USD 0++ unlock function that is used for vault stuff, and that was limited to a cap. So it's like there is somebody that was able to go primary for USD 0++ on 300K, I think, something like that. Like there was no fund that was steal from anybody. It just like reduced the time of the exiting for a small portion of USD 0++.
Awesome. Anita.
And that's a problem because DeFi Llamas put hack on the description, but it's not a hack, like it's an exploit, you know, it's something different. It's not like somebody has stole something. The guy has stole time of the protocol, but it's the only stuff he has stole. Like he has stole future revenue in certain way, and on like 0.5% because it was capped because of that.
Yeah, well, if a protocol is in a way that allows somebody that should not have money to come with that money, then I think the Filama it's a fair evaluation, even though it's not. It can be pretty scary to call it a hack when no users lost money, right?
Yeah.
Okay, so Anita is asking. So one thing that we do is we leave the last minutes for members to ask some questions too. And Anita is asking, what sort of so you have scaled. You're a fairly new protocol, and you have scaled very fast. What technical or infrastructure choices allowed you to scale so fast without compromising security?
I think it's because of I would say that the core element of the protocol has pretty simple architecture in certain ways. So there is not like a big attack surface that exists, and that's what allows us to have something very delimited, and with a lot of, we have been able to make a lot of audits on the same portion of code. We have been able to have a clear monitoring, etc. because of that. I think it's mainly and on the scaling is the same. It's because it's simple. the minting engine that allows the mint of USD0 and allow to accept collateral, etc. Is pretty yes, it's pretty simple because it's basically price checking, and we have a lot of double check, etc. on that because Oracle can have problem. There is like price checking where there could be some stuff, but we have a double check. There is redemption abuse, like stealing from the collateral, but this you can have, I would say, hard counter to that, like having permissioned asset like USYC. And even the assets that are not permissioned, we make them in rapid permissioned form in the collateral. So there is no possibility of somebody, if he get access to the smart contract that owns the fund, is not able to send it to somebody else, so to another address. And aside that, there is not a lot of exploit in or hack you can do because it's pretty simple. It's like there is the mint, the redeem, the check of the price, the check of the token integrity, and the permission.
The KISS methodology, yeah. Keep it simple, stupid. Yeah.
Yeah.
Cool. Okay.
I will say that the for example, the USD0 plus unlock logic, etc. is a little bit more complex, and here we had a little problem when we use this redemption permission features, but it's no solve.
Mm-hmm. So looking ahead, what are the biggest bottlenecks for scaling real-world assets-backed stablecoins, and how is Usual preparing to solve them?
I would say competition, adoption. I think the biggest bottleneck is the crypto ecosystem itself. Like it's great because you can grow quick, but the capital is mercenary, and the battle for attention is always here. And unfortunately, attention matters more than fundamentals. So it's not about what you build, but how you sell what you build. And I think that's here the biggest challenge, because to be integrated everywhere is not about having the best protocol. It's more about having the best entry, having the best network, having the best storefront in certain way, and that's where we think we will continue to improve to get back to a better level of excitement and vision and dream, because we think we have made something big. We have very strong commitment to build what we build, but we have been too silent, and we have to be more to communicate more and to be more in front of the scene and in the limelight. And that really, I think, the bottleneck to scale, because I don't see any I don't see like technical bottleneck. I don't see financial problem. I don't all that kind of stuff. I think we have strong base, and we can build on top. Governance could be something in the future, but we are still early, so it's manageable, I would say. And the decentralization process is always something that takes time on the long run. The more difficult stuff is getting attention back, getting hype back, getting people having some sharing our dream in certain way. And clearly in crypto, it's very important. That's why meme coin have some time even more value than a very useful service or incredible tech, like we saw a lot in crypto.
Speaking of excitement, what can we get excited about? Let's finish with this. What can we get really excited about with Usual? Maybe in the future, maybe now, maybe like massive yields on stables. Like, give us something to get excited.
To be honest, we are working on many other assets. That's something exciting, because we are like I would say the co-founder team is French, and we still not have issue an euro. So yeah, it's something that will come very soon, and even more since the dollar is is getting lower and lower. So it's for sure, we want to expand the FX logic and have and give access to many different currencies, because we think that there is market for every currencies, and that the currency world order is starting to change, and we need to be in that change. We also want to extend to other assets, like we have done with ETH, because we'll issue a liquid staking ETH, and you will be able to also earn usual reward by giving us your ETH, giving to the protocol, and the other stuff we work on, I cannot speak about. We will explain soon what we are doing behind the scene in certain way, but we are working on several. I would say others product, not directly usual, because since the beginning we have a lab vision in certain way on what we do, and our goal is to provide services and provide product and bricks that are useful for decentralized finance. And so we have 2-3 side products that should emerge in the next month.
Awesome. So we can get excited about a new announcement that's gonna happen soon. Okay. Well, Adley, thank you so much for coming to the dOrg Hot Seats, then helping us dive into the world of stablecoins, which again have always been there, but only recently people started realizing that, hey, this is from the beginning what one of the killer use cases has been. Thank you so much. Where should people find you and usual? Do you want to share we're going to put them in the show notes, but where maybe you can
the best way is on X, to be honest, with usual money, at usual money.
At usual money, all together.
Yep.
Perfect.
No space, no dash.
Fantastic. Thank you so much again, Adley, and see you next time.
Thank you for hosting, and have a great day.
Thank you.
Bye.